Holding cash right now is an active strategy to impoverish yourself. Vanguard projects U.S. equities at 4.2% to 6.2% over the next decade. That's half the 10% annual bull run from 2010 to 2020. History shows the Fed's rate hikes can stall markets for years. High-yield savings hit 5.25% at Marcus by Goldman Sachs mid-2024. Ally Bank mirrors that with a 4.40% rate. Cash yields beat your average checking account, but risk real inflation loss. JP Morgan warns missing the 10 best S&P days cuts returns by 54%. Time in the market matters more than timing the market. Every day you hold cash, you risk missing a feast. McKinsey data shows periods of zero growth last longer than you think. Vanguard's forecast is a warning, not a goal. Your cash pile is a liability, not an asset. You need a machine, not a treasure chest. Let's build that engine, chapter by chapter. Step 1. Lock in stability with high-yield savings accounts. Mid-2024 rates, Marcus at 5.25%, Ally at 4.4%. That's risk-free cash return in a zero-sum inflation game. Next, dividend aristocrats deliver durable growth. Procter & Gamble and Johnson & Johnson raised payouts 25 years straight. They yielded an average 10.5% annually over the last decade. Add liquid real estate via diversified REITs. Narrate data shows 10.1% returns over 20 years ending in 2023. No landlord headaches, just quarterly distributions. Complement with low-cost ETFs from iShares or Schwab. Bloomberg forecasts the ETF market to hit $15 trillion by 2026. Core holdings keep fees at a fraction of active funds. Institutional giants like Vanguard and BlackRock dominate this arena. Layer yields and growth with minimal friction. Your base is built, now add automation. Automation transforms occasional investing into relentless drip-feed growth. Robo-advisory market is a $62 and $38 billion juggernaut by 2030. Grandview Research pegs CARE at 29.7%. Betterment and Wealthfront handle tax loss harvesting automatically. That adds roughly 1.1% to net annual returns. Acorns roundups feature funnels spare change into your portfolio. Users invest about $30 per month, data shows. Microtransactions leverage behavioral finance to build capital. Millennial founders at Acorns prove consistency beats timing. Make robo-advisors your co-pilot. They enforce discipline, zero manual errors. You wake up richer without lifting a finger. Slash fees under 0.25% with institutional platforms. Scale automation across accounts with Plaid or Yodlee. The money machine works while you sleep. Top-tier investors are shifting to private credit and alternatives. Morgan Stanley reports 75% of HNW investors embrace private credit. Private debt can yield north of 8% uncorrelated to equities. Then comes decentralized finance. Ethereum staking yields 3 to 4.5% APR post-Denkin. Validators secure the network and get paid in ETH tokens. Crypto risks are high, but so are returns. Balance with AI-driven growth stocks. BlackRock sees AI-integrated firms boosting productivity by 30%. Invest in AI ETFs or platform leaders like NVIDIA. The productivity upside compounds inside automated portfolios. Private equity, venture funds, specialized debt, layer them in. Aim for a 60-40 alternative core split. Diversity is the oxygen of resilience. Pour in alternative fuel to rev your money machine. Every machine needs safety valves. Tax loss harvesting offsets gains against losses. Platforms like Betterment handle this automatically. The average lift is 1.1% per year, plain savings. Retirement planning demands a safe withdrawal rate. Morningstar's 2024 update sets the bar at 4%. That's sustainable for a 30-year horizon. Compound inflation forecasts and bond yields into the model. Protect your principal with bond ladders. Use municipal bonds for state tax advantages. The rule of 72 remains your compass. At 8% adjusted returns, your assets double every 9 years. Ramit Sethi's flow, 50-60 fixed costs, 10% investments, 5 to 10% savings. Automate direct deposits into these buckets. You'll never miss a critical allocation. The final lever is patience. JP Morgan shows missing the 10 best days costs you 54%. Those 10 days could happen back to back in crises. Reacting means expelling your capital at the worst moment. Let's talk future shocks. Global tensions, AI risks, climate events loom. Your money machine must withstand volatility. Stress test with Monte Carlo simulations. Adapt allocations as regimes shift. Data-driven rebalancing prevents emotional errors. Stay invested through drawdowns. Track performance, but don't drift. The next decade demands more moderate growth. Your machine has to generate yield and alpha. Are you ready to pull the lever or watch your wealth erode?